Good morning, I'm Steve Harding. I thought I'd take today an opportunity to review the latest update on the proposed lease accounting changes, and the debate continues to roll on. There has been some activity since the exposure draft came out in August of last year, and the comment period concluded in December of 2010. And some of those changes related to a meeting that the FASB had in February with the International Accounting Standards Board, and then again in May. And I thought I'd review kind of where they were at in February and now where they're at in May, because it's dramatically different. And really it surrounds a few key areas, and it deals with some of the complexities that were introduced in the exposure draft. They came out in February and said that they were going to address those complexities, that they were going to address some of the concerns they heard in the comment letters to the exposure draft. And so they came out in February, and they really went a long way to reducing a lot of the complexities and some of the subjectivity associated with the new standards. But then lo and behold, in May, they came back out and reversed many of the February positions, and now really have gone back to and really reiterated much of what they originally came out with back in August of last year in the exposure draft. So I thought I'd review some of those key items. The first one has to do with the liability that tenants are going to have to put on their books relative to the leases. And if you'll remember again, the liability is going to be the net present value of the lease stream, of the rental stream that the tenant has to pay. It was proposed in February that potentially they were going to allow the tenant to amortize that liability on a straight line basis, just like they're doing it today under FASB 13. Now they've come back and they've repeated what they said in the exposure draft, and that is they want tenants to recognize that on a net effective interest method. And a net effective interest method is just like your residential mortgage at home. That means the interest expense is higher during the first half of the lease. So that means the tenant's net operating income is going to be lower. And then on the back half of the lease, it's going to be higher. And at the end of the day, at the end of a 10-year lease, you're going to get to the same rent expense. But again, it's just that recognition of the rent expense that's different. And what was concerning tenants and a lot of observers of this proposed treatment was that the lower net operating income was going to be very problematic because it was going to be meaningful to tenants. So now we're back to that point where they're saying it's a net effective interest method. They also talked about in February 2 different methods for tenants to recognize their leases. And actually it was going to be very similar to the treatment that we have today, where we have operating leases and we have capital leases. And they were going to call those finance and other than finance. The finance lease was just like a capital lease where you have to put it on the balance sheet today. The other than finance is just like an operating lease. And so it was going to be very similar to today's treatment. And everybody was very encouraged that they were talking about that and that they were reversing some of the complexities again that were proposed in the exposure draft. Well, they came back in May and now they've reversed their position. They said that we're back to one treatment, and that is they want all liabilities and assets associated with the lease transaction on the balance sheet. So we're back to where we were with the exposure draft. Another item that was addressed in February that caused a lot of angst with the exposure draft relative to option periods, and whether you have to include option periods in your lease liability that you're setting up on the books. Originally, back in the exposure draft, they said you were going to have to evaluate every option period and look at some of the economics of those option periods and make an assessment of whether you were going to have to include the option periods in the lease liability, resulting in a higher lease liability on your books. Then in February, they came back and they said, no, we'll only make you include option periods if it has significant economic incentive. If there's a significant economic incentive for the tenant to exercise that option, then you have to include it in the liability and asset you put on the books. Well, now they've given further direction and clarity what that significant economic incentive is, and the reality is there's going to be a lot more options that will have to come on the books. And that's a result of things like if the tenant has significant leasehold improvements, then that will have to possibly be factored in as an option period that you're going to extend because you've put a lot of money into your lease space. They're also looking at some subjective things, which is the more problematic, and that is things like, what is management's intent? What is the historical practice? And interestingly, they've also now talked about what's industry practice. And if it's quote industry practice, and everybody in the industry, like you're a retail tenant and you have a great location on a kind of a main location, if you've always extended and exercised options, or if people like you have always extended their options, then again, they're suggesting that you have to include that in your liability. Another area that they addressed in February and May is with regard to the presentation of the liability and the assets, both on the balance sheet and on the income statement. And with regard to the income statement in February, what they had come back to was saying that you could present all of the lease obligations and the amortization of that obligation, the expense associated with that obligation, as one line item on your income statement as rent expense. So very similar to what it is today. Now they've come back in May and said, no, we've thought about that again, and now we think there should be three components on the income statement. The asset that you put on the books should be amortized on a straight line basis. The liability should be done on this net effective interest method that I talked about before, so the interest expense. And then the third component is the normal operating expense component for CAM, taxes, insurance, and utilities. So those you'll treat as an operating expense on your income statement as a separate line item. So really you're going to have three components now for that lease that you've signed. You'll have the amortization expense of the asset, the interest expense associated with the liability that you put on the books, and then normal kind of CAM, taxes, insurance, utilities as a third line item on your income statement. So you can imagine when you look at your income statement and try and look at the impact of a lease, now you're going to have to look at multiple line items as opposed to just looking at rent expense. And then with regard to landlords and where they're at relative to landlords and what will landlords have to do with this proposed treatment, they're really back to not having a consensus at all between the FASB and the International Accounting Standards Board. There is no consensus. Right now they're still looking at three different treatments. One was the performance obligation approach, the other was the derecognition approach, and they're even throwing on the table, maybe we don't change it at all. And so there's a great deal of disparity between the two boards, and so there's a lot of work to be done and quite a big bridge to build before they're able to reconcile their differences on the landlord treatment. Another thing that has come up between February and May, and this is actually a good thing, and that is the proposed timing. Right now, they were going to come out with the final standards. It was their intent to come out with the final standards actually in this month, in June. And they have reversed their position on that. And they've said, look, we're not going to release any standard until we've fully vetted this, until we've talked to the investors, until we've talked to the constituents, until we've spoken to tenants, until we've spoken to CPA firms, and really come up with a consistent position that'll stand the test of time and that will be more meaningful than what we have today. So they've said, we can't get that done by the end of the second quarter. And so they've pushed back their internal kind of timeline to be probably the fourth quarter of 2011 before they're done with coming out with their final position on lease accounting. And it could actually extend into the first quarter of 2012. And then with regard, if they do release it fourth quarter 2011, first quarter 2012, when will all this be implemented? It'll be implemented probably in 2015. And so that sounds like a long way off. Here we are in 2011, so we're talking 2015. But the reality is that for our public company clients who present comparative financial statements, that means that typically they present 3 years back. So if this goes into effect on 2015, they're actually presenting 2015, 2014, and 2013. So they're going to have to measure their assets and liabilities for all their leases effective 1/1/2013. So even though it's an effective date of 2015, they're going to present comparative financial statements going back to 2013. So that means a tenant is going to have to be in a position to measure the assets and liabilities effective January 1st, 2013. So that's the latest update relative to some of the changes that the FASB and International Accounting Standards Boards are considering at this point. I think it's changing. I'll keep you guys updated. By no means is it set in stone at this point. Many observers are still hoping, including myself, that we get to a position that we can all agree on, and that is, okay, I think we all understand that we want assets and liabilities associated with lease obligations on the books as opposed to just disclosed in the financial statements. But I'm still hopeful, and I think a lot of people are still hopeful, that a lot of the ambiguity, the complexity, and the subjectivity are removed from the final standards before this is ultimately released later this year or the first part of 2012. Thank you. Have a good day.